Ever wondered how the stock market works? Buckle up, because we're about to embark on a thrilling journey through the bustling world of stock markets. First things first, let's define what a stock market is. In simple terms, a stock market refers to a public marketplace where buyers and sellers trade shares of publicly held companies. These shares, also known as stocks, represent ownership in a company, and the stock market is where these shares are bought and sold. Now, what role does the stock market play in an economy, you ask? Well, it serves as a crucial cog in the economic machine. By facilitating the buying and selling of stocks, it helps companies raise capital to grow and expand. It also provides individuals and institutions with a platform to invest their money, potentially earning returns if the companies they invest in perform well. Let's take a brief walk down memory lane to understand the history of stock markets. It all started in the 17th century with the Amsterdam Stock Exchange, the world's first official stock market. Fast forward to today, and we have a global network of stock exchanges, from Wall Street's New York Stock Exchange to the Tokyo Stock Exchange and beyond, trading trillions of dollars every day. So, who exactly are the players on this grand stage? We have the investors, who buy stocks in hopes of earning returns over time. There are traders who aim to profit from short-term price fluctuations. Then we have the brokers, who act as intermediaries between buyers and sellers. And of course, there are the companies themselves that list their shares on the stock market. To sum it all up, the stock market is a bustling, dynamic ecosystem where shares of companies are traded. It's a place where companies raise capital, where investors seek to grow their wealth, and where traders try to profit from price swings. Now that we know what the stock market is, let's delve deeper into its dynamics. What makes up the stock market? Well, the stock market is a complex ecosystem comprised of various elements, each playing a crucial role in its functionality. At the heart of the stock market are stocks. These are essentially shares of ownership in a company. When a company decides to go public, it divides its worth into multiple shares of stock, which are then sold to investors. This process, known as an initial public offering, or IPO, allows companies to raise capital to expand and grow their business. Now, you might be wondering, where does this trading occur? That's where stock exchanges come into play. Stock exchanges such as the New York Stock Exchange or the National Stock Exchange of India are regulated marketplaces where stocks are bought and sold. They act as a meeting point for buyers and sellers, facilitating the exchange of stocks at prices determined by supply and demand. But what about private companies? Unlike public companies, private companies do not have their shares listed on a stock exchange. Their stocks are often held by a small group of investors and are not readily available for trading to the general public. Moving on, let's talk about stock indexes. An index is a statistical measure that reflects the performance of a group of stocks. Some well-known indexes include the S&P 500, which tracks the performance of 500 large companies listed on U.S. exchanges, and the Nifty 50, which represents 50 major Indian companies on the National Stock Exchange. These indexes help investors gauge the overall direction of the market and serve as a benchmark against which individual stock performances can be measured. So, there you have it, the basic components of the stock market. Stocks, public and private companies, stock exchanges, and indexes all work together in this vast financial ecosystem to facilitate the trading of company shares. Understanding these components is the first step towards grasping the functionality of the stock market. How does stock trading actually work? You may find yourself asking this question, and rightly so. The process of buying and selling stocks is a fundamental aspect of investing that every budding financier needs to grasp. Let's begin by understanding what exactly a stock is. Think of it as a small slice of a company that you can own. When you purchase a company's stock, you're essentially buying a piece of that company, making you a shareholder. Now, on to the actual trading. This is where brokers come into play. A broker is an individual or firm that acts as an intermediary between buyers and sellers. You, as an investor, place an order to buy or sell stocks through a broker who then executes the order on your behalf. In today's digital age, these transactions are typically made on online trading platforms. These platforms provide a virtual marketplace for buyers and sellers to interact and trade stocks. You can think of these platforms as a sort of online bazaar where instead of vegetables and spices, people are trading shares of companies. Now, let's touch upon bids, asks, and market orders. The bid is the highest price a buyer is willing to pay for a stock, while the ask is the lowest price a seller is willing to accept. When these two prices match, a trade is made. A market order, on the other hand, is an instruction given to the broker to buy or sell a stock at the best available price. While market orders are executed quickly, the final trade price may differ from the price when the order was placed, especially in volatile markets. In essence, the mechanics of stock trading involve a series of steps: choosing a broker, setting up a trading account, researching and selecting stocks, placing orders, and finally, monitoring your investments. Stock trading might seem complex at first, but with some practice, it becomes second nature. Remember, every master was once a beginner, so don't be intimidated. Take it one step at a time, and before you know it, you'll be trading stocks like a pro. How do you understand market trends? Well, market trends are like the heartbeat of the stock market. They are patterns or tendencies that emerge in the market over a period of time. They give us valuable insights into how the market might behave in the future. Let's start with the two main types of market trends: bull and bear markets. A bull market is characterized by rising prices and optimistic sentiment. It's like a charging bull, full of energy and forward momentum. On the other hand, a bear market is marked by falling prices and pessimistic sentiment. It's like a hibernating bear, slow and cautious. Understanding these trends is crucial for investors. In a bull market, it's generally a good time to buy stocks as prices are expected to rise. Conversely, in a bear market, selling stocks might be a wise move as prices are expected to fall. But remember, these are general strategies, and one size does not fit all. News and events also play a significant role in shaping market trends. For example, a positive earnings report from a major company might ignite a bull market, while a political crisis might trigger a bear market. Investors need to keep their fingers on the pulse of current events to anticipate these shifts in market trends. But it's not all about following the herd. Successful investors often go against the trend, buying stocks in a bear market when prices are low, and selling in a bull market when prices are high. This strategy, known as contrarian investing, requires a good understanding of market fundamentals and a healthy dose of courage. In conclusion, understanding market trends is like reading the mood of the market. It's about being aware of the big picture, keeping an eye on current events, and having the flexibility to adapt your strategy as the market changes. It's a blend of science, intuition, and sometimes a little bit of luck. So, to answer the question, how do you understand market trends? It's about paying attention, staying informed, and being adaptable. Because in the end, market trends are crucial for making informed investment decisions. What are the risks and rewards in stock trading? Let's delve into this exciting topic. First, let's talk risks. Stock trading, like any investment, comes with the potential for loss. Imagine buying shares in a company that unfortunately goes bankrupt. In such a scenario, the value of your investment could plummet to zero. Market volatility or the rapid and significant price swings can also lead to substantial losses. Then there's the risk of inflation. If the returns on your investment are less than the rate of inflation, you're essentially losing purchasing power. But don't let these risks deter you. They can be managed. How, you ask? Enter the concept of risk management. It's a strategy to identify, assess, and prioritize the risks to minimize, monitor, and control the probability or impact of unfortunate events. Diversification, or spreading your investments across different types of stocks and sectors, is a common risk management technique. Another is setting a stop-loss order, which automatically sells a stock when it reaches a certain price, thus limiting your loss. Now let's shift gears and talk about rewards. The potential for significant financial gains is what attracts many to stock trading. If you invest in a company's stock and it performs well, the value of your stock increases. You can then sell your shares for a profit. This is known as capital appreciation. Then there's dividend income. Some companies distribute a portion of their earnings to shareholders in the form of dividends. If you own stocks of such a company, you'll receive a regular income, which can be a nice supplement to your regular income or pension. Lastly, there's the benefit of ownership. When you buy a company's stock, you become a part owner of that company. This can bring a sense of pride and involvement in the company's growth and success. Understanding the risks and rewards in stock trading can help you make better investment decisions. Remember, the stock market isn't a casino. It's a platform for you to invest in businesses and grow your wealth over time. Happy investing!